Hello, and welcome to Investment Insight, your clear take on the markets. Let's get started.
Great to be here. A lot to get into today.
It is Tuesday, February 17th, 2026. And, looking at the global map this morning, things feel different. We're seeing a couple of really massive economic shifts that I think prove that old saying, money often moves a lot faster than
Well, that's
politics.
faster. And you know what? It's usually more honest. Politics is about what people say they value. Money. Money shows what they actually value.
And that is absolutely the theme today. We're seeing these pragmatic, wallet-based decisions just completely overriding political ideology.
Right. We have two perfect case studies for that. One just north of the border and one all the way across the Pacific.
First up, we're talking about Canada, America's, polite neighbor,
That's
usually our economic twin. But suddenly they're ignoring warnings from the Trump administration, and they are cracking the door open to Chinese electric vehicles.
And then we're going to follow the money. We're seeing investors taking profits, pulling cash out of those really expensive U.S. tech stocks and moving it somewhere else.
To Japan, of all places.
To Japan. It is a fascinating realignment. You've got a trade pivot in Ottawa and a capital pivot in Tokyo.
So our mission in this deep dive is to break these moves down, to try and separate the signal from the noise so you know exactly where the global economy is heading under the current administration.
Let's start with the controversy. Let's start with Canada.
This is a big one. The headline is that Canada has made this massive policy U-turn on Chinese EVs. And just to be clear on the timeline, this feels like a complete reversal. Just back in 2024, didn't Canada basically put up a brick wall against these cars?
They did. A fortress. In 2024, Canada had a 100% surtax, which is basically a tariff on Chinese EVs. The goal was to block them completely.
Just like the U.S. policy.
Exactly. Mirroring the U.S. approach. The idea was, protect the domestic auto sector at all costs.
And 100% tax. I mean, let's do the math. A $30,000 car suddenly costs $60,000 on the lot.
Right. Nobody is buying that. It kills the market dead. But now, in 2026, that wall has come down. That tariff has dropped to just 6.1%.
Wait, from 100% down to 6.1. That's not a tweak. That's a demolition job. What on earth happened?
The consumer happened. I mean, the data is telling a very, very clear story. The Canadian government blinked. A recent survey from Bloomberg and Nana's research shows the Canadian consumer mindset has shifted.
From what to what?
From origin to affordability.
Meaning people just stop caring where the car comes from.
To a huge extent, yes. The survey showed that 53% of Canadians,
The majority?
the majority, yes, say that a car being made in China does not negatively affect their purchase decision.
That's honestly surprising, given all the political tension you hear about.
Well, it shouldn't be if you look at their inflation numbers. For the last few years, the high cost of living has just forced a change in priorities.
It makes sense. It's like buying a toaster, right? Or a smartphone. Maybe a few years ago, you'd look at the brand's home country. Think about it.
You'd feel a little patriotic.
Maybe. Yeah, but now, your paycheck has been eaten by inflation for 3 years straight. You just look at the price. If it works and you can afford it, the flag on the box matters a lot less.
That is the perfect analogy. When that financial pressure hits, practical needs win. And the Canadian government is reacting to that pressure. They have aggressive climate goals. They need EVs on the road.
And Ford and GM just aren't making them cheap enough.
Not nearly. BYD and NIO are pricing for everyone. The legacy automakers are still pricing for the upper middle class.
Okay, but hold on. Is this a total free-for-all now? Can BYD just flood the streets of Toronto tomorrow?
No, and this is where the nuance is really important. It is not an open floodgate. Think of it more like a managed leak. It's a quota system.
A quota, so a limited number.
Right. Canada is allowing about 49,000 Chinese cars in at that low tax rate for now. It might go up later, but it is capped.
Okay, 49,000. That's significant, but it's not the entire market.
Exactly. And here's the other catch, the real fine print. While the tariff is low, these specific cars are excluded from the federal incentive checks.
Ah, so no subsidies. In Canada, that's, what, $5,000?
It can be, yes. So the government is saying, okay, we'll let your car in, but we're not going to help people buy it.
I see. It's like a nightclub. The government lets a certain number of people in for a cheap cover charge.
Yeah, yes, that's a great way to put it.
But once you're inside, you don't get the free drink tickets that the locals get.
Exactly.
Yeah.
You can come in, but you're paying full price at the bar. It's a conditional opening. They're trying to thread a needle here.
This brings us to the elephant in the room, or south of their border. We've got President Trump in the White House. The U.S. is keeping its walls incredibly high. How is this Canadian pivot playing out?
Not well,
Hmm.
to put it mildly. The U.S. administration, specifically the Transport Secretary and the USTR, has been openly critical. They warned Canada they will regret this decision.
Regret this decision. That sounds like a threat.
It is a threat. You have to
Mm.
remember, the USMCA, the trade deal that replaced NAFTA, is up for review right now in 2026. And the U.S. is very worried about the backdoor problem.
The fear that Chinese parts will seep into the North American supply chain through Canada.
Correct. And bypass all the U.S. tariffs.
So why do it? Why risk angering your biggest trading partner, the country that buys 75% of your exports?
It's risk management. It's a hedge. Look, Canada isn't suddenly switching sides to be pro-China. What they're doing is trying not to be 100% reliant on the U.S.
Especially with the unpredictability of U.S. trade policy right now.
Exactly. It's like having a best friend who's a little bit volatile. You don't dump them, but you start making a few other friends, just in case you need a ride home one night.
That's a really clear way to put it. So what does this mean for the industry itself?
Investors are viewing Canada as a beta test, a sort of test kitchen for Chinese cars in North America.
A test.
Yeah. Can these brands set up service centers? Can their batteries handle a Canadian winter? Can they win over Western drivers? Canada's where we're going to find out. If it works there, the pressure on the U.S. market will become immense.
There's one weird ripple effect here. I saw it in the analysis. One of the biggest beneficiaries of this could actually be an American company.
It's ironic, isn't it? We're talking about Tesla.
Tesla, how does that work?
Tesla has that massive factory in Shanghai. It's their export hub. With the old tariff, they couldn't ship those cars to Canada, but under this new quota,
They can ship the cheaper Shanghai-made models to Canada.
potentially, yes, could really help their margins. It's a bold, pragmatic move by Ottawa to separate their economic needs from American foreign policy.
Okay, so that's the movement of goods. Let's transition now to the movement of money. Because while North America is fighting over car tariffs, global capital is quietly flowing somewhere else entirely.
It's heading to Japan. We're seeing what some analysts are calling the Great Rotation of 2026.
Okay, let's unpack this. Why Japan and why now? For years, Japan was the market everyone just sort of ignored.
It was stagnant, yeah. But it starts with what's happening here, the push factor. U.S. tech stocks, all the AI companies,
Yeah.
they become incredibly expensive.
The valuations are just sky high.
Right. And for everyone listening, when we say PE ratio, that's price to earnings. It's basically how much you're paying for every dollar the company actually makes. And right now in the U.S., you're paying a huge premium.
So investors are getting nervous and taking some chips off the table.
Exactly. And they're looking for a bargain. Reuters is reporting a surge of funds leaving U.S. tech and heading to Asia, specifically Japan.
So if the U.S. market is a crowded, overpriced restaurant,
Then Japan is the place next door that just finished a huge renovation. The food's great, the service is reliable, and it's much, much cheaper.
and speaking of renovations, Japan's political scene just got one too, right? Something stabilized?
That's the pull factor, yes. The ruling party recently won a supermajority in the election.
And markets love that. They hate uncertainty.
A supermajority means no gridlock. It signals smooth sailing for policy. Investors feel safe putting their money there for the long term.
Okay, so we have cheap stocks and a stable government. Sounds like a slam dunk. But I'm guessing it's not all sunshine and cherry blossoms. There's a catch.
There's always a catch, and Japan's is a classic. The tension between making people happy today and paying the bills tomorrow.
This involves the new prime minister, Sanai Takaichi, and a promise she made.
A very big promise. To win that election, she promised to pause the grocery sales tax, the 8% VAT, to help with food costs.
Sounds great for the average person. Who doesn't want cheaper groceries?
It sounds great, but it's incredibly expensive. We're talking a 5 trillion yen hole in the budget, and Japan already has, just mountain of debt.
The highest in the developed world.
So they're cutting their income right when they need it most. And to make it even more complicated, the central bank, the Bank of Japan, is moving in the opposite direction.
They're raising interest rates.
Exactly, to 0.75%.
Which sounds tiny to us in the U.S., but for Japan.
For Japan, that's seismic. It's a 30-year high. They've been at zero for decades.
Oof. Okay, let me try an analogy. This is like deciding to cut back your hours at work, taking a pay cut at the exact moment your adjustable rate mortgage goes up.
That is a perfect and very dangerous combination. It feels good in the short term, but the math is terrifying. The bond market got very nervous about this.
And this all plays into that carry trade we hear about.
This is crucial. For years, investors borrowed money in Japan for free 0% interest and invested it in the U.S. to earn higher returns. It was free money.
But now,
Now it's not free anymore. The trade is unwinding. People are selling assets and buying back yen to pay off those loans.
which creates huge swings in the currency.
Massive volatility. You have the government spending weakening the yen and the central bank's rate hikes strengthening it. It is a total tug of war.
So for our listener who is thinking about a Japan ETF, what's the bottom line? Is it a trap?
It's not a trap, but it's not a simple trade. The takeaway is that Japan is a good, long candidate because of the corporate reforms and the sheer value, but
There's the but.
you have to watch that currency and the interest rates like a hawk. This is not a set-it-and-forget-it investment. You're buying a political experiment in fiscal management.
So don't just blindly follow the herd to the newly renovated restaurant. Check the menu prices first.
Exactly.
Yeah.
And maybe keep an eye on the kitchen.
So if we zoom out, what does this all mean? Canada opening to China, investors flocking to Japan.
If you connect the dots, the theme is just pragmatism.
Pragmatism. Explain that.
Well, look at the pattern. In Canada, consumers are choosing price over politics. They're voting with their wallets. In Japan, investors are choosing value over hype. They're moving to a market with real risks because the price is right.
So we're in a cycle where ideology is taking a back seat to reality. Whether you're a driver in Toronto or a hedge fund manager in Tokyo, you're looking for the practical, affordable option.
That's it. The vibes-based economy is over. The math-based economy is back.
So here's a final thought to leave you with. If Canada is a test kitchen, and consumers there are willing to overlook geopolitics for a cheaper car, how long until U.S. consumers demand the same? If a $15,000 EV is just across the border, how long will American voters accept paying $40,000?
That is the political time bomb no one in Washington wants to talk about.
And on the flip side, if Japan's gamble on tax cuts fails as interest rates rise, could that trigger the next global financial panic? The butterfly effect is real. A tax cut in Tokyo could absolutely impact your 401k in Texas.
Those are the questions we need to be asking.
Thank you for listening. We'll be watching these numbers closely for you. Don't forget to subscribe and hit that like button.